Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Covered Calls and Short Puts. And today we're talking about contracts. Getting into a contract is a big deal, even in the pursuit of income. So today we're going to be weighing the pros and cons of two example potential contracts to just explore the math associated with looking for income from covered calls. Really, strike selection when selling covered calls can be vital, so we want to understand the math. Before we get to any of that, though, we first of all say hello to everyone who's joining us out there in YouTube. Great to see so many familiar names. Hello there, Will and Scott. We have Lori and Eva and Rojo and David, Mark and Sharon, everybody else. Thanks for joining us week after week. We always do appreciate your attendance and your contributions to these discussions. If you happen to be among those who are here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the live stream has concluded, enjoy the recording. It's a great way to watch these webcasts. But be aware that you're invited to join us in this live stream if you'd like to be here on our audience. This is a Monday webcast series. We kick things off promptly at 2 Eastern time. Now, I also want to let you know that I'm being joined in the YouTube chat by my very good friend Barb Armstrong. She's going to be keeping an eye on any questions that I can't get to just during the flow of the presentation. She's going to help me pick up the slack there. So thanks for having my back there, Barb. Barb and I will also would also like to issue an invitation to everybody listening, whether live or on the archive, to follow us on social media. So you can find us on X, you can find us on LinkedIn, you can find Barb and me there on X. Barb at Barb Armstrong CS. You can find me on X at Cameron May CS, and my LinkedIn. Just go to linkedin.com/in/Cameron May CS. But let's get into this discussion of weighing different potential contracts for the selling of covered calls. What are the pros? What are the cons? What does the math say? As we do it, of course, we need to pause to consider the risks associated with trading and investing. This is important information, so bear these disclosures in mind. Options carry a high level of risk and are not suitable for all investors. Schwab does not recommend the use of technical analysis as a sole means of investment research. Investing involves risks, including the loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. All right, so with that said, let's set an agenda for how we're going to spend our time together today. So the first thing that I want to do is do a quick update on what's happened with a couple of our positions since we last met. So I've been out kicking around Scotland for 4 weeks. So we need an update. We had 3 positions in our example portfolio when I left. Now we have 1. So what happened to the other 2? We're going to follow up on that. Then we're going to take a look at what's going on with the markets. Just a very short update there. I'm sure that if you've watched some of our other webcasts today, you've already gotten an update on markets. Yep, having a very strong day. But then we're going to use that as a backdrop for planning and placing a new covered call trade. But in doing that, we're going to weigh 2 potential contracts. Which one might the investor or the income trader select? We'll weigh the pros and the cons. But let's get right into it. Let's go right to the Thinkorswim desktop. This is the paper money platform. And right now we're looking at Apple. Apple, we had a covered call on it when I left back in mid-May. So Mark says a lot has happened to past positions. Absolutely right. So here's the history of that position. It has a little bit of a history here. Started things off. We sold some puts back in December. They just expired. We kept the money, made 277. As a matter of fact, because Apple's rocketed up like this, it's kind of compressed the chart, and it's making my drawings all overlap on each other. So let's expand things here so you can see this a little bit better. Sorry, we're not going to be seeing some of this price activity up there. But we sold those December puts, $277 per contract, realized paper money returns, obviously. Then we sold some January put, a January put. That one was assigned. So a 265 put was assigned. We owned the shares at 265, and then we started selling calls. Sold some February calls, those expired for a profit. Sold some March calls, those expired for a profit. Sold some April calls, those expired for a profit. And then we were in a May contract, and I wrapped things up, packed my bags, and headed off. Well, that contract was assigned. So here we were. You'll see that red dashed line represents that May 270 contract. And the markets went, or the Apple price went well above 270. That was assigned, meaning the shares were purchased from us. We purchased those shares for 265, sold them for 270. made a $5 profit on the stock, modest profit on the stock to go with all the premiums that we collected along the way. So not a bad return. I think we made about 25 bucks per share, something like that. I'd have to go back and rerun the numbers, but not a bad trade. But that's the history for Apple. What happened to our Nvidia position? Similar extended history. Let me widen this out so we can see what happened here. Bought some shares back at 183.71. We started selling calls. Sold some November calls. Those expired for a profit. Sold some December calls. Closed those out for a profit. January expired for a profit. February expired for a profit. March expired. We closed that one for a profit. April closed for a profit. And then, our stock was just chopping all over the place. We ultimately wound up selling these May 185 calls. Now remember, we bought the shares for around the same price. So the shares turned out to be kind of a wash as price rocketed up again. Made a buck, a little bit more than a buck on the shares, but collected all these premiums along the way. So overall, again, not a bad trade. Now, obviously, what we need to discuss today, and this is going to be part of the discussion, is the trade-off. Okay, so we made profit, but was this the best way these trades could have gone? No, what covered call traders need to be aware of is that sometimes maybe just stock ownership might have been okay. Now, there's some significant volatility we might have had to put up with, but right now the stock itself is doing pretty well. Maybe better than doing the covered call here, but overall, it is what it is, but still an overall profitable trade. So that leaves us with one position. We have some Cardinal Health here. We own 100 shares. We purchased those shares. The shares are actually doing pretty well. Bought the shares for 155. They're trading at 225. So the shares are kind of killing it. But we're going to use this as our example covered call for today's example. Might as well. We already own the shares. But before that, let's go see what's going on with the markets. Let's look at the S&P 500. So let's see. When did I go on vacation? It was about here. So not a lot has net been accomplished since then. So the markets have been down, they've been up, they've been down, they've been up. This is a nice little move that we made to the upside for the bulls today. But we do have those all-time highs on the S&P 500 that for some, they might see that as a potential price ceiling. Whether it turns out to be that or not, we'll find out maybe in the coming days and weeks. But right now, we're pushing right up against that price ceiling. And for some, when price has been going up, but it's starting to encounter obstacles, that's when they might turn their attention to other strategies, such as income. Hey, JV Texan, thank you. Appreciate it. Yeah, so let's just put ourselves in the shoes of that sort of an income investor. Their portfolio, bullish portfolio. I know a lot of 401ks out there are doing pretty nicely right now, but there may be some that are concerned, are we going to bump our heads there? We'll see. But let's maybe look to generate some income, example income from this example portfolio through the employment of our CAH position. So we own 100 shares. That's important for the contracts. Most contracts, if you're not familiar with covered calls or options in general, most of them trade as what we call standard contracts, representing the potential exchange of 100 shares of stock. So we happen to own 100 shares. Here's what's going on with CAH. It has a much shorter history with us. Actually, we've owned it for a longer time frame, but we've done less with it. So we bought these shares back here at 155.40 and pretty much left them to their own devices for a while. Finally, sold a quick covered call right there. The April 26th. It was the April, what was the expiration? It was April 24th of, no, it was the 26th. Anyway, sold the 215 call. That was a quick expiration just right before an earnings announcement. The earnings created some choppiness and we just kind of rode through that. But now our stock has been rocketing up again, doing well, but it may also be encountering some resistance. Possible price ceiling overhead. Let's kind of draw that in here. Where's that going to be? Maybe around 230? Let's say that our would-be investor here has been enjoying the ride on their CAH shares recently. That feels nice. But maybe they're concerned about this immediate overhead resistance. So if price appreciation isn't really looking intriguing for the near term, maybe we can get some income from this. So let's sell a covered call, but I want to compare two different potential contracts. We're going to stick with the same month just to sort of keep the expiration consistent. Let's say we're going to do one or the other of two potential contracts for July's expiration. June is right around the corner. Those June contracts are expiring in just a few days. Right now it's Monday. There's a holiday on Friday if you weren't aware, so make sure that you're aware that contracts are ending on Thursday, the tradability of those contracts. All right. But let's push out here to July for our example. And I want to weigh a couple, but let's keep in mind this 230 price ceiling. So as we go to our trade tab, let's go out here to the July contracts and let's enter into example contract number 1, which is potentially selling a 230 call. Now there's something I want to acknowledge here before we even talk further. This is something that a trader might want to keep an eye on. Does anybody have any objections? I'm going to be looking at the 230 and the 240 calls on CAH. Is there anything that somebody might take exception to, object to in using these as examples? What strikes you? For those that are, oh no, not what strikes you, that's the wrong word. What impresses you as we look at these two different strike prices? For some of our more veteran traders, they might look at that 230 call and look over here in our calls in the left column and say, wait a second, Cameron, the bid price is 410. The ask price is 510. There's about a 20% range between the bid and the ask. So what that might imply for our would-be trader here, our income investor or trader, is let's say they just decided to sell that 230 call. Well, when we sell options, we commonly sell at or near the bid price. Hey, how much are you going to bid me for this contract? And we sell to the highest bidder. So that's $410, $4.10 times 100 shares, $410. And if we get immediate seller's remorse, hey, give me those shares, or give me that contract back, let me buy it back. So we buy at the ask price. How much are you going to ask for me to buy that back from you? $510. There's a $100 spread. It's $1 per share on these contracts. Now, for some, that may exceed their acceptable limits. Now, those sorts of personal rules are going to vary from one trader to the next. For some they might look at, let's say, this ask price, and if there's more than a 5% or a 10% difference between those two, they may choose to not go ahead with the trade. That's not going to be everybody, but for some, it might just be an indication that there's going to be a lot of what we call slippage in this trade. It also might be an indication that there's poor liquidity with the trade, or comparatively poor liquidity than when compared to maybe other stocks. But I'm going to go ahead with this trade anyway. Now we could take that same bid ask knowledge and apply that to the 240 strike. That also looks like it's a little bit more than 20% spread between those two. So I do want to acknowledge, yep, I saw that. But CAH is what we have. So as our covered call investor, let's just put ourselves in those shoes and just say, well, we got to deal with what we got. So Mark is calling something else out. I don't know how deeply I'm going into that today, Mark, but I think it's still a valid observation. Mark says the implied volatility of CAH, which has an impact on the pricing of options, is only just above the 1-year floor at the moment. So to say that differently, these premiums, the stock has been, or the expectation for volatility is at 12-month lows at or near, which typically causes the options prices to come down. Well, when we're trying to sell something, it's nice to see higher prices. At least that's a typical preference of an income investor. And that's not what we're getting right now. But guess what? CAH is what we have. So let's go forward, having acknowledged those two elements of the income trading decision. Let's do a comparison of the 230 and the 240. All right. Now I could be comparing any number of other strike pairs. Those are just going to be our two examples today, but I just want to talk through what it means that we're getting into. And then we could definitely, the trader, once they understand comparing these two, well, they could compare these two, or they could compare these two, or they could compare really any other combination. So this is going to be our example combination today. So right now we have our shares are at, let's make this bold. There we go. Our shares are trading at 225.84. I just want to make a note of that because things are going to change as we're talking. The markets are open, so these numbers are going to change. But let's say that we have 100 shares and they're worth 225.84 at current market prices. Well, let's do our example income trade. This is going to be example trade A, which is going to be the first, well, I could actually call this the at the money call. What that means is we're just looking at the strike price that's closest to the current price of the stock. And with the stock close to 226 bucks, 230 is as close as we can get. So that's what we'd call our at the money call. And specifically, we're going to do a covered call. There we go. So we own the shares. We're going to get into a contract here where we sell the 17th of July 230 call. And again, that looks like that's trading between 410 and 510. Let's try to make that less painful. See if we can get a fill halfway between those two. Try to reduce the slippage on this trade. If we're able to sell this for 460, that creates our covered call. So here's explicitly what we're getting ourselves into. Someone out there in the trading universe is theoretically here paying us $4.60 per share times 100 shares. That means they're paying us $460. You get some parentheses in there. There we go. They're paying us $460 for exclusive access to our shares. That's the deal. They're paying us $460, and in exchange, we're saying, okay, mystery other participant, other trader here, through the 17th of July, you can buy our shares for $230 per share. In the old days, they might have done that over the telephone. Hey, I'm calling for those shares. And we might have said, that's okay, I got you covered. I got the shares right here. But for the next 32 days or through the 17th of July, someone else is going to have the right to buy our shares from us for $230. Why would the investor or the trader be willing to get themselves into this deal? Well, let's look at some of the rest of the math of this. This is sort of math consideration number one, which is the size of the premium being collected, $460 being paid. All right, that's not nothing. That's about 2% of the current value of the stock. Not quite. Well, no, it is. It is 2% of the stock. But in exchange for that premium, there's an obligation. We know that we now might have to sell our shares for $230. The trader might be willing to do this because they just don't think the shares are ever going to be worth much more than $230, at least not for the next 32 days. So let's just say, to extrapolate on our earlier discussion, let's say that our shareholder thinks that if we go up to $230, we might bump our head into that, and come July 17th, our shares are still worth less than $230. If we go through $230, above $230, where do those per share profits go if we're in a contract where someone else has the right to buy those shares from us? That's a consideration. So Abe Lucas says, how were we able to calculate the premium for that call? So Abe, all I did here, I just looked at what these, you might consider this sort of the advertised price. It has changed since we started talking. And as a matter of fact, that spread just narrowed in a big way. But when we first started talking, it said 410 for the bid, 510 for the ask price. I just went at about the mid, halfway between those two at 460. Let's just say that our trader put in an order saying, you know what, I want 460 or don't fill me. So that's where that came from. And it's just an example. Right now, that might be more like halfway between 440 and 490, it might be more like 465. Anyway, but what we need to consider is the obligation here to, let's put this in parentheses, maybe sell at $230. That's the deal with this contract. We need to be very aware of that. And does it happen? Yeah, it just happened to us with our Apple position. It just happened to us with our NVIDIA position. If a stock goes rocketing up, we are keeping that premium, but boy, the stock might be sold to someone else for less than its current market value. That's a reality that a would-be covered call seller just needs to be aware of. So if our stock goes up to 240 or 250 or 260, someone still has the right, unless we choose to buy out of the contract. And with kind of stickier contracts where the liquidity isn't as strong, might be a little bit harder to do that. But in any case, unless we choose to buy out of that contract, we still have the obligation to sell to someone else for 230 bucks. Now I say maybe here because it's up to them. All right, so that's something we need to be aware of. So the premium is a consideration. The obligation, certainly a consideration. What does this do when we collect the $4.60 premium? What does that do for how much risk the investor or the trader has in their position? Well, let's do a little comparison here. Let's say that we do this covered call. And we're comparing that to someone who chooses not to do a covered call at all. And then the stock goes down. Well, let's say our stock, let's stay here on the chart. Let's say that our stock falls further than we thought. Let me activate this drawing. And let's say by July 17th, our stock has really come down. It's at 215 bucks. Okay, so it's come up here to 230, rocketed down, really come down and not doing well. Well, if we just own the shares and they were worth 225 and they've come down to 215, that's a $10 ding to our portfolio in unrealized loss. But if we, along the way, we collected $4.60 in income, and let's say that that just expires and we keep that income of $4.60, now we have a little bit of a consolation prize. We've reduced the risk in the portfolio, and as a matter of fact, it has moved the break-even point down by the amount of the premium. So if our shares are at, let's abbreviate break-even to BE. If our shares were at 225.84 at the moment we sold this call, but we collected $4.60 in income, if that income is ultimately realized, that lowers the break-even here to $221. I'm just doing this math in my head. Call me out if I get it wrong. And 24 cents. Do you see what I did just there? So if the stock price falls, let's say it falls down to 221.24. Ouch, it fell $4.60. Ooh, but we have $4.60 that was collected from our premium that helps to offset that. In that case, that's a wash. That's a break-even position at expiration. So that can be very important math. Mark says down by the amount of the premium. Ooh, with an important addition there, Mark. I'm glad you put this in your comment. Less the commission, right? Yeah, there are commissions to be paid on options. We don't pay commissions on every type of trade, but on options there are commissions. I leave that out of these discussions just for simplicity's sake, but when we go place the order, you'll notice that there's an example commission being charged that would chip away, instead of getting $4.60 on, or $460 on this contract, it would be, if we're able to fill at $460 minus a 65-cent commission. So $459.35 in this hypothetical scenario. Good. Thank you, Mark. Appreciate that. Now, a final, for this example, consideration for our trader here is what's the likelihood that we actually do wind up having to sell the shares for 230 bucks? What is the probability that we get called out or that we get assigned? is another way that we say that. So let's phrase this as prob of assignment. There we go. What's the probability of assignment? Well, there's actually a number that might be quite useful here on our option chain. It's called delta. And if we look at the 230 strike that we're considering, and we look over at the delta, it's a 43. What does the delta mean? Well, it can mean a couple of things. Number one, for some traders, it can mean how much our contract can go up or down in price by as a result of a $1 change in the stock price. So that's one interpretation of delta. But another thing that it can tell us is it's a rough approximation of the probability that this contract is in the money, or in other words, that our stock is above $230 at expiration and the contract gets assigned. So the probability of assignment, notice it was 43. We are in a dynamic market right now. The markets are open, still trading for another hour and a half today. So this just changed from 43 to 42. That's okay. It's all an estimate anyway. So we'll say that there's approximately, if we just sell this covered call and we put some blinders on and just let the trade go to expiration, and it unfolds however it may, about a 42% chance that we get assigned. Now, let me ask you, as scary as that sounds, is assignment always a bad thing? If we do this trade A, this at the money covered call, and we agree to sell our shares to someone else for $230 maybe, and then they say, yep, I'm going to do it, and they buy those shares for $230, is that a negative outcome? Well, depends on perspective, really. From day one, what this means is, well, at least we made $4 more than we could have on day one had we just sold the shares at that point. We also might consider how much what we originally paid for the shares. We actually bought these shares back here at 155 bucks. So this would be selling the shares for a $65 profit, if my math is correct there. Yeah, I think it is. But if the stock is trading at 250, 270, 300 at the time we're assigned and we have to sell it for 230, that's where it can feel kind of painful. It's a forced taking of profits in our case, but we're selling under market value at that point. So we need to be aware of that. But these are some of the important elements of when we choose to get into a covered call. What is it exactly that we're getting ourselves into? But this is just one example. Let's do a comparison. Let's weigh the pros and cons. Let's look at another one. Now, another thing that might contribute to this decision is just that the trader sees a potential price ceiling here at 230. Well, look at this. We actually got above that, a few dollars above that for a few hours. Maybe our trader would prefer to have a little bit more cushion. Let me pull down the right margin here. And let me draw in another line. I'm going to do this up above today's price. Let's go up here. And I'm going to draw in a line at 240. What if we did the 240 call? That's giving us more wiggle room to the upside. But let's do a comparison and do example trade B. Example trade B is going to be an out of the money covered call. It's not the strike price that's closest to the current price, but a strike price that's above the current price to some extent. Vintage Early says, how much is the cost of the stock? So I hope you caught that, but we paid $155 some time ago. Right now, it's $225. And we're agreeing to sell it for $230, a little bit above what it's currently trading for. Well, what if we did an out of the money call? And instead of selling the 17th of July 230, let's look at the 240. So what we're doing here is we're asking someone else, the other party in this example transaction, hey, I don't want to sell you my shares for 230. I want to charge you more. If you ultimately want to buy my shares, you're going to have to pay me a higher price. Well, guess what? They're not going to be thrilled to pay $4.60 for that right. They're actually going to be willing to pay less than the original. So look at this. Going further out of the money, in other words, requiring a higher price of the other trader that they'd have to pay for the shares, they're paying a lower premium. So it's somewhere between $1.55 and $2. Let's say we can get $1.75 there. So what's one immediate important consideration here? Lower premium. Yep, instead of getting paid $460, as an example, we're getting $175. Lower premium, is it a worse deal? Well, again, it depends on perspective. In exchange for that lower premium, our obligation has changed. Instead of having to potentially sell at 230, now we potentially have to sell at 240. We've given us $10 more upside growth potential in the stock price. Or another way to look at that is instead of having $4 of wiggle room, we have $14 of wiggle room. Mark says, Cam, you love these fully worked comparisons. You often wonder how far out of the money you should go. Yeah, could we go further here, Mark? What happens if we go further and further out of the money? The concept here again being, hey, I don't want to sell to somebody for 230. I don't want to sell my shares for 240. I prefer to sell for 250 or 260. Oh, that'd be awesome. 270, 280. Well, right now, it doesn't look like anybody wants that kind of a deal to any real extent. The 260 calls trading between 0 and 75 cents, that spread, we're probably going to struggle to even get an order filled right there. Now, that's another reason why I kind of chose 230 and 240. That's really where any of the trading is actually happening. All right, let's see. Abe says, since the covered call requires us to own 100 shares of a ticker, how are we able to de-risk with less capital? Good question, Abe. There are definitely some other strategies where, and this is just as an example, it's not a promotion of a strategy, but maybe instead of buying a stock, a trader buys another call. A call gives the trader the right to buy the stock. Instead of buying it outright, we then own the contractual right to buy the stock. That creates a covered scenario if we want to then sell short calls against that, create things like vertical spreads. But I'm not going to go any further into that strategy. It would be a little far afield for this discussion, which is covered calls and short puts. But our obligation has shifted positively for this trader, for the owner here. All right, so that's sort of a counterbalance to the smaller premium that we were receiving. But as the scales teeter back and forth, what's happening to our break even? If we have a smaller income, what does it do for the risk modification here? Yeah, we only have $1.75 in the account to help us adjust for a drop in price. Now our break even is just over 224. Always, if you catch me making a math error, let me know, because sometimes I'm talking, I'm doing multiple things, and I'm trying to do the math of the trade in my head. But this looks like this is a 224 break even, because if the stock falls, let's say it falls $1.75 from 225.84, and look at this, it's on the move a little bit. It can move. If it goes down to 224.09, that would mean that we have a $1.75 loss on our share ownership compared to when we first looked at this stock. But we did get $1.75 in income. That's a wash. That's a break-even trade at expiration. So pro, let's say there's a con, smaller premium. Pro, higher price obligation where we might have to sell the shares. Con, a higher break-even point, not as favorable. But finally, what's a pro? So we have con, pro, and the pro here is the probability of assignment. Let's go back to our delta. There was about a 42% chance that the 230 strike ultimately gets assigned and we have to sell the shares at 230 if the trader looks at that as a negative outcome. What about the 240? It has a 21% probability of assignment on that delta. So we've kind of slashed the probability of ultimately having to sell our shares by half. So if that's the objective for our trader, if they really don't want to sell their shares, well, they've reduced that risk. They've certainly not eliminated it. Yep, we could turn out to have to sell the shares anyway, but in that case, we sell the shares for $240, making, in that case, about $16, not 16, my math just blew up, $14 compared to day one, plus the $1.75. So that's close to $16 all told. And compare that to example trade A. Hey, if we have to sell the shares for 230 and they were worth 226-ish, it's only about a $4 profit realized gain on the stock. Well, compared to day one. But we did get our premium. So that would be like $8 and change. So this trade, more upside potential, but less downside protection. This trade, more downside protection, less upside potential, and a higher probability of getting called out. So which one should we do? What do you think? Looks like it is nice that our spread between our bid price and ask price has tightened up here. I think I'm going to sell this 230 call. That's right at that resistance level that we discussed. Let's go right there, click on the bid price to create a contract. Now in my portfolio, that goes to a default of selling one contract. For each contract, we have to have 100 shares, and we only have 100 shares, so that's one contract. You can see that right there. So let's sell that one contract, 230 call. Let's see if we can get somewhere between, we might not be able to get 460 anymore. Let's see if we can get 445. And I'm going to confirm and send that order. So let's sell the one call, 17th of July, 230 call for 445. Now this is telling us max profit is 445 or max loss is infinite. This would be true. It would have infinite loss potential if we didn't own the shares that we're agreeing to sell to somebody else. But this, since we're selling a call on some shares that we do own, it doesn't have unlimited loss potential. There is a commission to be paid here, so that could chip away at the premium collected. But let's send this order off and see if we can get a quick fill. I don't know if we will, because that liquidity is not strong here. When you see a wide spread between the bid price and the ask price, it's commonly an indication that liquidity is not great on this. So we'll see if this fills. If it doesn't, oh well, we just still own the shares. But guys, we've accomplished what I set out to do today. I wanted to talk through how important strike selection can be. Oh, it's like we sold it for 465. Look at that. We were thinking maybe 460 all along. We have 465. But in any case, the math of strike selection can really be vital when selling covered calls. There are all sorts of pros and cons associated with the different strike prices that can be chosen. So hopefully this gives you a good introduction to those pros and cons. If you need to run through this on paper money and think through it on your own on an example trade, I think that could be helpful. But time for me to let you go. I'm happy to be back in the saddle though again. I will be back again tomorrow for another webcast. Barb, thanks for helping out in chat. But everybody, as I set you loose to go enjoy the rest of our webcasts, I do want to make you aware of some additional resources available to you free of charge from Schwab Education, starting with our social media. Okay. If you're not following your favorite Schwab presenters on social media, I think you should, because it's really the only place to connect with us in between the live streams when the camera's not on. So you can find Barb and me on X. You can find Barb there at Barb Armstrong CS. You can find me on X at Cameron May CS. And for example, if you were following me, you'd know where I've been for the last month. I've been off in Scotland. Ooh, so here's some pictures from Utah. Just got back to Utah. There's a great picture of my Scotland trip. Came back to Utah, headed up in the mountains. It was beautiful up there. But normally it's market related stuff. And if you reply to my posts there on X, I just try to reply right back to you. But you can also follow us on LinkedIn. So you can find Barb on LinkedIn. To find me on LinkedIn, you go to linkedin.com/in/Cameron May CS. Give me a follow there. And I post here as well. So if you reply to my posts on LinkedIn, I just try to reply right back to you. All right. Now, the final thing that I would strongly suggest is that if you are new to Schwab Education, welcome, but make sure that you have subscribed to our YouTube channel. You can click on the subscribe button right down below. It doesn't cost anything to do that. It only takes a second to do it. But this is where you can join our live streams like this one right now. So the YouTube channel name is Trader Talks Schwab Coaching Webcasts. You can join our live streams here, and you can find playlists of previously concluded webcasts. So like if I go to playlists and I scroll down a bit, Barb actually filled in for me while I was gone doing covered calls and short puts. But This one happens to be down toward the bottom. Let me just scan through here. I'm always looking for my face. And takes me, there it is. No, it was, sorry, Barb. I gave you credit. You can keep it, but it was actually Mike Fairborn. Thanks, Mike, for filling in. But there's our covered calls and short puts archives. So if we click on view full playlist, you can see Mike's discussions while I was gone. There's the last time I held a webcast. There's Barb. So there, you earned a credit. But time for me to let you go. Thanks for giving me your time today. Very much appreciated. I will see you in tomorrow's webcast or in another webcast for the rest of the week. I'll also look for you on social media, on X and on LinkedIn. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.